Summary of the Ascent of Money, A Financial History of the World by Niall Ferguson. What are the big ideas? The role of innovative financial techniques in creating economic bubbles. This book highlights how innovative financial techniques, such as the issuance of paper money and inflation taxes, have played a crucial role in creating economic bubbles throughout history, from the Mississippi Company in France to the stock market bubble of the late 1990s. The book sheds light on the consequences of these financial innovations when used improperly or fraudulently, leading to economic instability and widespread financial losses. Central banks' impact on stock markets. While it is well known that central banks influence monetary policy through interest rates and quantitative easing, this book explores their role in shaping stock markets as well. It discusses how regulatory changes like the repeal of Glass-Steagall or MiFID have affected stock markets and highlights the impact of central bankers' actions on the volatility of these financial markets. The evolution of insurance markets. The book provides insights into the history of insurance as a means to manage risk, from its origins in ancient Rome to the present day. It discusses how insurance has evolved as a financial instrument and its role in protecting individuals and businesses against various risks. The book also highlights the limitations and challenges associated with insurance markets and their impact on the broader economy. Microfinance as an alternative to welfare states. The book explores microfinance institutions' potential to help lift people out of poverty, offering an alternative to traditional welfare state systems that are increasingly unsustainable due to growing debt levels in some countries. It discusses the benefits and challenges of this financial instrument, including its role in promoting entrepreneurship and reducing poverty. The symbiotic relationship between China and the United States. This book offers a unique perspective on the economic relationship between China and the United States, which came to be known as Chimerica. It explores how their economies have been interconnected through trade, capital inflows, and financial markets, creating a symbiotic relationship that has raised concerns about fair competition and currency manipulation. The book highlights how this economic relationship evolved during the 2007 to 2008 financial crisis and its implications for the future of global finance and economics. 1. Introduction. The financial system plays a crucial role in economic development by facilitating transactions, allowing for savings and investment, and managing risk. Money has evolved from physical forms like cowrie shells and precious metals to paper currency and digital representations. Credit has been an essential component of financial systems since ancient times, but the modern credit system is characterized by complex financial instruments and institutions like banks and securitization markets. The bond market is a key driver of long-term interest rates and economic stability, and central banks play a crucial role in managing inflation and stabilizing financial markets. Insurance can be an effective way to manage risk, but it comes with costs and limitations. Real estate has been a popular investment due to its potential for appreciation and the perceived security of having a physical asset, but it also comes with risks and requires significant capital. The history of finance is marked by booms and busts, as well as periods of integration and fragmentation. Financial globalization has led to increased opportunities for financially knowledgeable individuals, but also increased risks for those who are financially illiterate. Understanding the origins and evolution of financial institutions and instruments can help shed light on their current role in the economy and the challenges they face in the modern world. John Kenneth Galbraith, the Harvard economist, was fond of asking two important questions about money. Whence it comes? Where it goes? It is precisely these questions that Niall Ferguson, who is also based at Harvard, wishes to address here, albeit with an important difference. While Galbraith wrote as an economist, Ferguson writes as an historian of finance. They, however, share an ethical passion in common, the need to educate the layperson by contributing to the challenge of financial literacy. And, again, they share a common preoccupation with the problem of economic downturns and financial crises in the Anglo-American world, which, more often than not, is not just a theoretical question for academics but takes on the form of a difficult, lived experience for large sections of the population when the viability of firms, investments, or livelihoods might be at stake. What Galbraith and Ferguson are determined to get across in their work is the simple, but oft-forgotten, lesson that financial crises are endemic to capitalism as such and therefore cannot be solved merely as a set of contingent, technical, problems of the macroeconomy. Instead, they must be understood in terms of how crises repeat themselves within the history of economics and finance. It is therefore important to know where financial institutions are coming from, why they were set up, the constraints under which they function, the regulatory provisions that determine their boundaries, and so on, in order to understand what they are up to at any point in time. 2. Financial literacy. A tale of two crises, financial literacy and the ascent of money. In the bustling heart of 2008, as the global financial system teetered on the brink of collapse, a stark reality emerged: a widespread lack of financial literacy played a significant role in the unfolding crisis. This realization wasn't limited to ordinary citizens. Even the so-called masters of the universe on Wall Street had seemingly forgotten, or perhaps never learned, the crucial lessons of financial history. Niall Ferguson's The Ascent of Money offers a compelling narrative journey through the history of finance, highlighting the importance of financial literacy in navigating the complexities of the modern financial world. The book doesn't explicitly tell a story focused on financial literacy. Instead, it unveils the evolution of financial institutions and concepts, offering readers the tools to understand the financial system's interconnectedness. Through historical anecdotes and analysis, The Ascent of Money subtly reveals the dangers of financial illiteracy, as seen in the parallels between the historical bubbles and the 2008 crisis. The Dutch tulip mania of the 17th century serves as a cautionary tale. Driven by speculation and a lack of understanding of the underlying value of tulips, prices skyrocketed before crashing spectacularly, leaving many investors financially ruined. John Law's financial experiment in 18th-century France demonstrates the perils of unchecked money creation and speculative frenzy. Law's ambitious system ultimately collapsed, leaving the French economy in disarray and underscoring the importance of sound monetary management. The subprime mortgage crisis of 2007 to 2008, which Ferguson analyzes in the book's later chapters, provides a contemporary example of the dangers of financial illiteracy. Many borrowers entered into complex mortgage agreements without fully comprehending the risks involved, leading to widespread defaults and a financial meltdown. By understanding these historical parallels, readers can glean valuable insights into the importance of financial literacy in making informed decisions and avoiding the pitfalls of financial speculation and excessive risk-taking. The Ascent of Money argues that financial literacy is not merely about understanding technical terms and concepts. It's about recognizing the power of money to shape history and influence human behavior. From the Medici bankers of Renaissance Italy to the bond traders of Wall Street, finance has played a pivotal role in shaping the course of human events. The inherent risks and uncertainties associated with financial markets. Booms and busts are an integral part of financial history, and understanding this cyclical nature is crucial for making sound financial decisions. The importance of responsible financial behavior and long-term planning. By understanding concepts like compound interest, debt management, and risk diversification, individuals can empower themselves to make informed financial choices and secure their financial future. The book emphasizes that financial literacy is not solely the responsibility of individuals. Governments, educational institutions, and financial institutions all have a role to play in promoting financial education and fostering a culture of responsible financial behavior. By illuminating the historical journey of money and finance, The Ascent of Money implicitly underscores the critical need for financial literacy in navigating the complexities of the modern financial world. It serves as a reminder that understanding the past is essential for shaping a more stable and prosperous financial future. 3. What is money? What then is money? What is the role that it has played in the history of finance? What is it that Ferguson wants us to know in addition to the usual descriptions of money in textbooks of macroeconomics? What will the differences be in terms of how the reader will think about problems of decision-making after reading this book in everyday life? Only the first of these questions, I am afraid, has a direct answer, the rest require a willingness to think about the relationship between the structural and historical dimension of financial scholarship. Ferguson starts with the usual definition of money as a unit of account, medium of exchange, and store of value before listing its varied properties. While this is only to be expected, what Ferguson is able to do as a master storyteller is to weave the historical instances which illustrate or problematize the functions and properties of money within a narrative framework that works on the analogy of the evolutionary. Galbraith and Ferguson are also committed to the idea that a serious theoretical inquiry into these questions is not merely of academic interest but must be communicated to as large an audience as possible, so that the learning from such an exercise not only passes on to how the population at large thinks about taking financial decisions in their everyday life, but are also able to appreciate the constraints and demands on policymakers when they have to take decisions that affect the macroeconomy. The need to understand and explain how the macroeconomy works is also linked to the idea that financial literacy is a prerequisite to exercise the freedoms and the rights that are enshrined in the Anglo-American notion of political subjectivity. This is a passion that is also to be found, for instance, in how financial institutions define the need, on their part, to communicate the significance of their decisions to their constituents, especially in situations such as the economic meltdown of 2008. Understanding the role played by Galbraith as an important predecessor, as Harold Bloom might put it, then is an interesting way of both appreciating and situating Ferguson's work. This book is also accompanied by a television series given, not surprisingly, the seriousness that Ferguson attaches to the idea of communicating with as large an audience as possible. 4. Dreams of Avarice. The Mountain of Silver and the Dreams of Avarice, a financial history lesson. In the heart of the Bolivian Andes, the Spanish conquistadors stumbled upon Cerro Rico, the rich hill, a mountain teeming with silver ore. This discovery, a physical embodiment of avarice, set in motion a chain of events that would profoundly impact the global economy and illustrate the potent allure of wealth. Niall Ferguson, in The Ascent of Money, uses the story of Cerro Rico to introduce the concept of money as a physical embodiment of value and the dangerous dreams of avarice it can inspire. The Spanish, blinded by their desire for quick riches, plundered the mountain silver, flooding the European market and inadvertently triggering inflation. This episode, a precursor to the modern concept of quantitative easing, highlights the delicate balance between money supply and economic stability. The story of Cerro Rico, a mountain of silver. The story of Cerro Rico begins with the Spanish conquistadors' insatiable desire for gold and silver. In 1532, Francisco Pizarro, an illegitimate son of a Spanish colonel, led an expedition to Peru in search of precious metals. Like Christopher Columbus before him, Pizarro's primary objective was to find and monetize precious metals in the New World. Pizarro and his men believed in the legend of El Dorado, a mythical Indian king who covered his body with gold dust. While they didn't find El Dorado, they did discover something just as valuable, Cerro Rico, a mountain with a peak reaching 4,824 meters, 15,827 feet, above sea level. In 1545, an Indian named Diego Gualpa uncovered the 5 great seams of silver that lay within Cerro Rico, forever changing the economic history of the world. For Pizarro and his men, silver represented more than just a shiny, decorative metal. It was a source of money, a unit of account, a store of value, and portable power. To extract the silver from the mountain, the Spaniards initially paid wages to the indigenous population. However, the demand for labor soon outstripped the available workforce. To solve this problem, the Spanish instituted the mita system, a form of forced labor that compelled indigenous communities to send a portion of their men to work in the mines. Conditions in the mines were brutal. Thousands of indigenous people died due to the harsh working conditions and the dangers of the mines. An Augustinian monk, Fray Antonio de la Calanca, wrote in 1638 that every peso coin minted in Potosí has cost the life of 10 Indians who have died in the depths of the mines. As the indigenous workforce dwindled, African slaves were imported to replace them as human mules. Despite the horrific cost in human life, the Cerro Rico proved immensely profitable for Spain. Between 1556 and 1783, the mountain yielded 45,000 tons of pure silver. This silver was turned into bars and coins at the Casa de Moneda, mint, in Potosí and then transported to Seville. The influx of silver from Cerro Rico made Potosí one of the largest cities in the Spanish Empire, with a population peaking at between 160,000 and 200,000 people. However, the abundance of silver did not bring lasting prosperity to Spain. As the Spanish flooded the European market with silver, the metal itself lost value, leading to a period of high inflation known as the Price Revolution. Ironically, the mountain of silver, a symbol of avarice and wealth, ultimately contributed to Spain's economic decline. Cerro Rico stands as a powerful reminder of the complex relationship between money and power, the dangers of unchecked greed, and the enduring human desire for wealth. However, the story doesn't end with the Spanish and their mountain of silver. Ferguson weaves a narrative that connects this historical episode to the broader themes of the book. The evolution of money. While the Spanish fixated on silver as a representation of wealth, the ascent of money traces the evolution of money from tangible commodities to intangible systems of credit and trust. The dangers of financial illiteracy. The Spanish, fixated on accumulating silver, failed to grasp the complexities of monetary systems and the dangers of inflation. This historical example underscores the recurring theme of financial illiteracy and its potential to destabilize economies. The human element in finance. The story of Cerro Rico reveals the powerful human emotions associated with money, greed, ambition, and the relentless pursuit of wealth. These emotions, Ferguson argues, are inherent in financial systems and can lead to both innovation and disaster. The ascent of money suggests that the dreams of avarice, exemplified by the Spanish quest for silver, are a constant throughout financial history. While the forms of money and the methods of its accumulation may evolve, the fundamental human desires driving these pursuits remain. By understanding the historical context of these desires and learning from past financial follies, Ferguson argues, we can better navigate the complexities of modern finance and mitigate the risks associated with the ever-present dreams of avarice. 5. Of human bondage, the rise of the bond market. The story of human bondage, as explored in Niall Ferguson's The Ascent of Money, is not about personal servitude, but about the captivating ascent of the bond market, a financial instrument that has held governments and individuals alike in its powerful grip. Ferguson uses this chapter to illuminate how war, the perennial father of all things, birthed the bond market, and how this seemingly mundane financial instrument rose to become a dominant force in global finance. The narrative begins in medieval Italy, where cities like Florence pioneered early forms of government bonds to finance their conflicts. These bonds, initially simple records of debt in leather-bound volumes, evolved into tradable securities that allowed investors to profit from lending money to the state. This marked the emergence of a liquid market for debt, a crucial step in the development of modern finance. Ferguson then shifts the narrative to the tumultuous era of the Napoleonic Wars. He introduces Nathan Rothschild, the enigmatic financier who, through shrewd manipulation of the bond market, amassed a fortune and exerted significant influence on European politics. By skillfully exploiting information asymmetry and leveraging his vast network, Rothschild demonstrated the immense power that could be wielded through mastery of the bond market. However, the Rothschilds weren't just cunning opportunists. They recognized the symbiotic relationship between governments and bondholders. By financing governments, they enabled wars and fostered economic growth. In return, they reaped substantial profits and gained political clout. This intricate dance between finance and power, Ferguson argues, has been a recurring theme throughout history. The story of the bond market doesn't end with the Rothschilds. Ferguson traces its evolution through the 19th and 20th centuries, highlighting the growth of national debt. As governments increasingly relied on bond issuance to finance their activities, the bond market became a central pillar of the global financial system. The emergence of new bondholders, the rise of institutional investors like insurance companies and pension funds broadened the base of bondholders, further entrenching the bond market's influence. The impact of inflation and wars and hyperinflation, particularly in the 20th century, profoundly affected the bond market, demonstrating its vulnerability to political and economic shocks. The Ascent of Money suggests that the bond market, for all its complexities, is fundamentally a reflection of human relationships, between borrowers and lenders, governments and citizens, risk and reward. By understanding the historical forces that have shaped this market, we can better appreciate its profound impact on our lives and the global economy. The chapter title, Of Human Bondage, serves as a subtle reminder that while bonds may appear as impersonal financial instruments, they are ultimately tied to human actions and motivations. Whether through the avarice of a conquistador, the ambition of a Napoleon, or the anxieties of a modern-day investor, the bond market remains a testament to the enduring power of financial relationships. 6. From Tulip Mania to Enron, A History of Financial Bubbles. The chapter Blowing Bubbles in the Ascent of Money takes the reader on a captivating journey through some of history's most infamous financial bubbles. Niall Ferguson uses these historical examples to illustrate the recurring patterns of irrational exuberance, speculative frenzy, and the inevitable crashes that have punctuated the history of finance. The story begins with the Dutch tulip mania of the 17th century. What began as a fascination with exotic tulips from Turkey transformed into a speculative frenzy as tulip bulb prices skyrocketed to astronomical levels, only to collapse dramatically in 1637. Ferguson uses this episode, often considered the first recorded financial bubble, to highlight the powerful psychological forces that can drive market behavior. He then explores the Mississippi Bubble, orchestrated by the Scottish financier John Law in 18th-century France. Law's ambitious scheme to revitalize the French economy through a combination of paper money, central banking, and colonial speculation initially generated enormous enthusiasm. However, his elaborate financial edifice collapsed when investors lost faith in his paper currency, leading to a devastating financial crisis that crippled the French economy. Through these historical narratives, Ferguson identifies several key characteristics of financial bubbles. Displacement. Bubbles often begin with a technological innovation or a shift in economic conditions that creates new opportunities for profit. The introduction of paper money in France, for example, created a fertile ground for Law's speculative schemes. Euphoria. As prices rise, investors become increasingly optimistic, leading to a self-reinforcing cycle of speculation and rising prices. This exuberance can spread like a contagion, drawing in ever larger numbers of investors. Mania. At the peak of the bubble, prices become detached from any rational assessment of value, driven solely by speculative frenzy. This is exemplified by the tulip mania, where a single bulb could be traded for the price of a house. Distress. As prices begin to decline, doubts creep in, and the most astute investors start to sell. This can trigger a domino effect, as more and more investors rush to exit their positions. Revulsion or discredit. The bubble bursts, and prices collapse, leaving a trail of financial wreckage. Investors, once blinded by greed, are now consumed by fear and regret. Ferguson also emphasizes the role of easy credit in fueling these speculative episodes. The availability of cheap and abundant credit allows investors to leverage their bets, magnifying both profits and losses. He points to the South Sea Bubble of 1720, which was exacerbated by the Bank of England's expansion of credit. Furthermore, Ferguson highlights the human element in these financial disasters. He argues that bubbles are not simply the result of irrational markets, they are also driven by deeply rooted human emotions, greed, fear, and the herd mentality. The chapter title, Blowing Bubbles, serves as a metaphor for the fragility of human judgment and the ephemeral nature of financial booms. The chapter concludes with a sobering reminder that financial bubbles are not just historical curiosities, they are a recurring feature of modern finance. From the 1929 stock market crash to the dot-com bubble of the late 1990s, Ferguson argues that these episodes are more than just periodic market corrections, they are symptomatic of deeper flaws in the financial system and the human psyche. By understanding the historical patterns of financial bubbles and recognizing the psychological factors that drive them, Ferguson suggests, we can be better prepared to navigate the inevitable booms and busts of the future. 7. Shifting Sands of Security, The Return of Risk. The chapter The Return of Risk and the Ascent of Money charts the evolution of risk management, highlighting the enduring human struggle to attain financial security in an inherently unpredictable world. Niall Ferguson argues that while we constantly seek to mitigate risk, our efforts are often undermined by our own flawed judgment and the inherent complexities of the financial system. The story begins with a stark reminder of the world's inherent dangers: Hurricane Katrina's devastating impact on the Mississippi Delta in 2005. This natural disaster serves as a powerful illustration of the unpredictable nature of risk and the limitations of our attempts to manage it. Ferguson then traces the development of insurance from its humble beginnings in 18th century Scotland. The genesis and growth of modern insurance. The story of insurance, as told in the sources, begins in 18th century Scotland, where two Church of Scotland ministers, Robert Wallace and Alexander Webster, recognized the need to provide financial security for the widows and orphans of their fellow clergymen. Prior to this period, insurance existed in rudimentary forms, primarily focused on maritime trade. These early arrangements often resembled conditional loans rather than true insurance policies. It was not until the 17th century that a dedicated insurance market began to emerge in London, spurred by events like the Great Fire of 1666, which highlighted the need for fire insurance. Wallace and Webster, along with mathematician Colin Maclaurin, sought to establish a more robust and sustainable system of financial protection. Their efforts culminated in the creation of the Scottish Ministers' Widows' Fund in 1744, a groundbreaking institution that laid the foundation for modern insurance. Several factors contributed to the success and impact of the Scottish Ministers' Widows' Fund. Sound actuarial principles. Instead of relying on a simple pay-as-you-go system, Wallace and Webster advocated for the accumulation of a fund that could be invested for long-term growth. This forward-thinking approach, based on the calculation of life expectancies and investment returns, ensured the fund's financial stability and sustainability. The maximum principle. The fund operated on the principle of maximizing capital accumulation through investment, allowing it to generate sufficient returns to cover annuity payments to widows and orphans. Expansion beyond clergymen. The fund's success quickly attracted interest from other professions, leading to the establishment of similar funds for university professors and artisans. The Scottish Ministers' Widows' Fund marked a pivotal moment in the history of insurance, demonstrating the viability of a system based on sound mathematical principles and long-term financial planning. It served as a model for similar funds established throughout the English-speaking world, paving the way for the widespread adoption of insurance as a means of mitigating financial risk. Over time, insurance expanded beyond its initial focus on death benefits to encompass a wide range of risks, including fire, shipping, and even the lives of soldiers. By the 19th century, being insured had become a hallmark of respectability and financial prudence. The sources also highlight the profound impact of insurance on the development of financial markets. As insurance companies grew, they became major investors, channeling the premiums paid by policyholders into a wide range of assets, including stocks and bonds. The development of insurance was not without its challenges. The sources acknowledge the inherent tension between insurance companies and policyholders. The complexities of insurance contracts and the potential for disputes over coverage underscore the need for clear communication, transparency, and a fair balance of interests between insurers and the insured. He highlights 6 crucial breakthroughs that laid the foundation for modern risk management. Probability, the understanding that fear of harm should be proportional not just to the severity of the harm, but also to the probability of the event occurring. Life expectancy. The development of actuarial tables allowed for more accurate calculation of life expectancy, enabling the creation of life insurance. Pooling risk, the concept of spreading risk across a large pool of individuals through mutual insurance societies. Insuring against fire, the creation of fire insurance, spurred by the increasing urbanization and the growing threat of fire in densely populated areas. Reinsurance, the development of reinsurance allowed insurance companies to share the risk of major disasters, further mitigating their exposure. Government regulation, the increasing role of government in regulating insurance markets to ensure solvency and protect policyholders. Ferguson argues that the evolution of insurance, along with the development of social safety nets in the 20th century, created a sense of financial security, shielding individuals from the full brunt of risk. However, he warns that this sense of security is illusory. He points to the rise of neoliberal economic policies in the late 20th century, spearheaded by figures like Milton Friedman, as a turning point in this narrative. Friedman and his disciples advocated for the dismantling of the welfare state, arguing that it created a culture of dependency and stifled economic growth. Ferguson discusses the implementation of these policies in Chile under the Pinochet regime, where José Pinera, a student of Friedman's, spearheaded a radical overhaul of the Chilean pension system. This move, Ferguson suggests, marked the beginning of a broader trend towards privatization and individual responsibility, shifting the burden of risk back onto individuals. The chapter then turns its attention to the rise of hedge funds and the increasing complexity of financial markets. Ferguson examines the story of Kenneth Griffin, a hedge fund manager who epitomizes the appetite for risk in the modern financial system. He discusses the growing use of complex financial instruments like derivatives, which, while offering the potential for high returns, also expose investors to significant risks. Ferguson warns that the increasing complexity of financial markets, coupled with the dismantling of social safety nets, has left individuals more vulnerable to financial shocks. He argues that the rise of subprime mortgages and the subsequent financial crisis of 2008 are stark examples of this trend. The chapter concludes with a call for greater financial literacy, arguing that individuals need to be better equipped to navigate the increasingly complex and risky financial landscape. Ferguson reminds us that while the quest for financial security is a natural human impulse, true security lies in understanding and managing risk, rather than trying to eliminate it entirely. By tracing the evolution of risk management and highlighting the shifting balance between individual responsibility and collective security, The Return of Risk offers a timely reminder of the need for both prudence and innovation in navigating the ever-evolving world of finance. 8. Beyond Bricks and Mortar, a critical look at safe as houses. The chapter Safe as Houses in the Ascent of Money challenges the widely held belief that real estate is the ultimate safe investment. Niall Ferguson takes the reader on a journey through the history of property ownership, revealing the risks and complexities that lie beneath the seemingly solid foundations of bricks and mortar. The story begins by acknowledging the powerful allure of property. The sources note the enduring popularity of games like Monopoly, which center around acquiring and developing real estate. This fascination, Ferguson argues, reflects a deeply ingrained belief that property is a one-way bet to wealth and security. From aristocratic privilege to property-owning democracy, a look at the risks and complexities of owning property. The sources tell the story of property ownership, beginning with its concentration in the hands of a landed aristocracy and its evolution to a more widespread phenomenon, especially in the English-speaking world. This transformation, while seeming to democratize wealth and security, introduced a new set of risks and complexities. For much of history, owning land was the privilege of the elite. Estates were passed down through families, like the Duke of Buckingham's Stowe House, signifying not just wealth but also social standing and political influence. This system started to shift in the 1930s, particularly in the United States. The Federal Housing Administration, FHA, played a pivotal role in making home ownership more accessible. With government-backed mortgage insurance and the development of the 30-year fixed-rate mortgage, the FHA paved the way for the property-owning democracy. This vision of widespread property ownership, however, wasn't without its drawbacks. The sources point out the inherent risk of relying heavily on property as an investment. The sharp rise in U.S. house prices between 1975 and 2006 made home ownership a challenge for first-time buyers without family assistance. Moreover, the illiquidity of real estate, as evident during the 2007 to 2008 financial crisis, meant that homeowners facing financial difficulties struggled to sell their properties and avoid foreclosure. The idea of property as a safe as houses investment, often promoted by governments, ironically contributed to excessive risk-taking. The Savings and Loan (SNL) crisis of the 1980s exemplifies this. Deregulation, coupled with the belief in ever-rising property values, enabled SNLS to engage in risky lending, ultimately leading to a wave of defaults and a taxpayer bailout. This pattern repeated itself, but on a grander scale, with the subprime mortgage crisis of the 2000s. The securitization of mortgages, where loans were bundled together and sold as complex financial instruments like collateralized debt obligations, CDOs, concealed the true risks associated with subprime lending. This financial engineering, combined with lax lending standards and the unshakable faith in rising house prices, set the stage for a global financial crisis when the housing bubble finally burst. The sources challenge the universal appeal of the property-owning democracy model. The experience of Quilmes, a slum in Buenos Aires, reveals that merely providing legal title to property isn't a guaranteed path to economic upliftment. While ownership may offer a sense of stability, it doesn't necessarily guarantee access to credit or create wealth without a steady income and a well-diversified investment strategy. The history of property ownership, as illustrated by the sources, underscores the importance of a balanced perspective. Real estate investment can be beneficial, but it's crucial to recognize the inherent risks. The safe as houses mantra can be misleading, leading individuals and societies to underestimate market volatility and the necessity of sound financial planning. However, Ferguson challenges this assumption by examining the historical evolution of property ownership. He begins by highlighting that for much of history, owning land was the exclusive privilege of a wealthy elite. The vast majority of people were tenants, subject to the whims of their landlords. The rise of home ownership, Ferguson argues, is a relatively recent phenomenon. He credits the Federal Housing Administration, FHA, in the United States with playing a crucial role in promoting home ownership through government-backed mortgage insurance. This intervention, along with the development of the 30-year fixed-rate mortgage, made it easier for ordinary Americans to purchase homes. While acknowledging the social and political benefits of widespread homeownership, Ferguson also points out its potential drawbacks. Overdependence on a single asset, encouraging individuals to invest heavily in their homes can create an overdependence on a single asset class, exposing them to significant financial risk if property prices decline. Reduced labor mobility, home ownership can make it harder for people to relocate for work, potentially hindering economic growth. The illusion of security, the belief that property is as safe as houses investment can lead individuals to take on excessive debt, leaving them vulnerable to financial shocks. Ferguson then turns his attention to the savings and loan, SNL, crisis of the 1980s, a cautionary tale of the dangers of deregulation and the fragility of the financial system. He explains how the deregulation of SNLS, coupled with lax lending practices, led to a wave of risky real estate investments and ultimately a costly taxpayer bailout. The chapter then shifts to the subprime mortgage crisis of the 2000s, which Ferguson sees as a direct descendant of the SNL debacle. He argues that the securitization of mortgages, combined with lax lending standards and the widespread belief that house prices would continue to rise, created a perfect storm for a financial meltdown. Ferguson concludes by challenging the notion of property-owning democracy as a universally applicable model. He suggests that while homeownership can be a valuable asset for individuals and societies, it is essential to recognize the risks associated with overdependence on real estate. Key takeaways from Safe as Houses. Property is not always a safe investment. The sources highlight that property prices can go down as well as up, and that the illiquidity of real estate can make it difficult to sell quickly in times of financial distress. Home ownership can create risks. Encouraging excessive home ownership can lead to overdependence on a single asset class, reduce labor mobility, and foster a false sense of financial security. Financial innovation can amplify risk. The securitization of mortgages, while offering potential benefits, also created new avenues for excessive risk-taking and contributed to the subprime mortgage crisis. Regulation is essential. The sources underscore the importance of government regulation in mitigating financial risks and protecting consumers. By exposing the flaws in the safe as houses mantra and highlighting the complexities of the real estate market, Ferguson encourages readers to approach property investments with a more critical and informed perspective. He reminds us that true financial security lies not in clinging to outdated assumptions but in understanding the ever-evolving nature of risk and adapting our strategies accordingly. 9. From Imperial Dominance to Chimerican Interdependence, A Financial History. The chapter From Empire to Chimerica in The Ascent of Money examines the intricate relationship between financial power and geopolitical dominance. The narrative begins by tracing the historical trajectory of financial innovation, often propelled by the ambition of empires. The sources highlight how empires like the British Empire relied heavily on financial mechanisms to exert control over their colonies and extract resources. This often took the form of loans, investments, and trade arrangements that ultimately benefited the imperial power. However, the sources argue that the landscape of global finance shifted dramatically in the late 20th century with the rise of new economic powerhouses, particularly China. The concept of Chimerica emerges as a defining feature of this new financial order. Chimerica, a term coined by Ferguson and Moritz Schullerich, describes the symbiotic relationship between China and the United States, where China became America's primary creditor by accumulating vast holdings of U.S. Treasury bonds. The emergence of Chimerica had profound implications for both countries and the global financial system. For China, the strategy of accumulating U.S. dollar reserves helped fuel its export-driven economic growth. This financial dependence on the U.S., however, also made China vulnerable to fluctuations in the U.S. economy and the value of the dollar. For the United States, China's willingness to finance its massive current account deficit by buying treasuries kept interest rates low, fueling a consumer spending boom and a housing bubble. This dependence on Chinese capital, however, also raised concerns about the long-term sustainability of the U.S. economy and its ability to manage its debt. The sources suggest that Chimerica, while seemingly beneficial for both sides, was ultimately an asymmetrical relationship. China's economic growth outpaced that of the U.S., leading to concerns about a shift in the global balance of power. The 2008 financial crisis exposed the vulnerabilities of this interdependence. As the U.S. economy faltered, so did demand for Chinese exports, leading to a slowdown in Chinese growth. The crisis also raised questions about the stability of the U.S. dollar and the safety of Chinese investments in U.S. treasuries. Despite these tensions, Chimerica proved resilient. China continued to buy U.S. debt, helping to finance the U.S. recovery and stabilize the global financial system. The sources note, however, that the long-term viability of Chimerica remained uncertain. As China's economy continued to grow and its financial system matured, it sought to reduce its dependence on the U.S. dollar and establish its own currency as a global reserve currency. This transition, coupled with the rise of economic nationalism in both countries, suggested that the era of Chimerica might be coming to an end. Key lessons from Empire to Chimerica. The interconnectedness of global finance. The sources underscore that events in one country can have ripple effects across the global financial system. The Chimerica relationship highlights the deep interdependence between the world's two largest economies. The shifting balance of financial power. The narrative illustrates how financial power can shift over time. The rise of China as a major creditor nation challenged the traditional dominance of the U.S. in the global financial system. The importance of understanding history. The sources emphasize the value of studying financial history to understand the present and anticipate future trends. The historical patterns of empires and their financial strategies provide valuable insights into the dynamics of Chimerica. The inherent risks of financial interdependence. The sources suggest that while financial interdependence can bring benefits, it also creates vulnerabilities. The Chimerica relationship exposes both countries to risks that could destabilize the global financial system. By exploring the evolution from imperial finance to the era of Chimerica, the sources challenge readers to rethink traditional notions of financial power and consider the implications of a multipolar financial world. They highlight the importance of recognizing the interconnectedness of the global financial system and the need for greater cooperation to manage the risks and opportunities of a changing financial landscape. 10. Descending from the summit, navigating the complexities of money's evolution. The concluding chapter of The Ascent of Money, titled The Descent of Money, serves as a sobering reflection on the inherent instability and recurring boom and bust cycles that characterize the history of finance. Ferguson reminds readers that the seemingly unstoppable upward trajectory of the financial system, as detailed in the preceding chapters, is punctuated by periods of dramatic decline. This chapter encourages us to view the evolution of finance not as a smooth, linear progression but as a dynamic process shaped by innovation, adaptation, and occasional crises. The sources emphasize that the very complexity of modern finance, while enabling sophisticated risk management and resource allocation, also creates new vulnerabilities. The intricate web of interconnected markets, institutions, and instruments can amplify shocks and spread contagion rapidly, as witnessed during the 2008 financial crisis. Ferguson points to the subprime mortgage crisis as a prime example of how seemingly isolated problems in one sector can cascade through the entire system. The chapter challenges the notion that financial crises are simply a product of greed or individual malfeasance. While human behavior undoubtedly plays a role, Ferguson argues that the deeper causes lie in the structural features of the financial system itself. He highlights the inherent instability arising from fractional reserve banking, leverage, and the proclivity for excessive risk-taking during periods of prolonged economic expansion. The Descent of Money also explores the limitations of traditional economic models in predicting and explaining financial crises. Ferguson points to the widespread failure of economists to anticipate the severity of the 2008 crisis, underscoring the limitations of relying solely on mathematical models and rational expectations theory. He argues that a deeper understanding of financial history, with its recurring patterns of bubbles, panics, and crashes, is essential for navigating the complexities of modern finance. The sources suggest that the descent of money is not necessarily a negative phenomenon. It can be a period of creative destruction, where outdated institutions and practices are swept away, paving the way for new innovations and adaptations. The challenge, according to Ferguson, lies in managing these periods of decline in a way that minimizes systemic risk and preserves the essential functions of the financial system. Key lessons from the Descent of Money. Financial history matters. The sources stress the importance of learning from past financial crises. The recurring patterns of boom and bust provide valuable lessons for policymakers and investors alike. Complexity breeds fragility. The interconnectedness of the modern financial system creates vulnerabilities that can amplify shocks and lead to systemic crises. The limits of economic models. Traditional economic models often fail to capture the complexity and irrationality of human behavior, making them inadequate for predicting and explaining financial crises. Crises as opportunities for adaptation. Financial crises, while disruptive, can also be catalysts for innovation and reform, leading to a more resilient and efficient financial system. The concluding chapter of The Ascent of Money urges a more nuanced and historically informed approach to understanding the evolution of finance. By recognizing the cyclical nature of financial history and the inherent fragility of complex systems, we can better navigate the inevitable periods of descent and emerge from them with a more robust and adaptable financial system. 11. Navigating the Slight Depression, Insights from The Ascent of Money. The chapter The Slight Depression in The Ascent of Money offers a compelling analysis of the 2008 financial crisis, exploring its immediate causes, the policy responses, and the long-term implications for the global financial system. Ferguson argues that while the crisis was severe, it ultimately proved to be a slight depression rather than a full-blown economic catastrophe on the scale of the 1930s. The sources highlight the decisive role played by policymakers, particularly the Federal Reserve, in preventing a complete financial meltdown. The narrative begins by recounting the dramatic collapse of Lehman Brothers, a pivotal event that triggered a cascade of failures across the financial system. The sources describe the panic that gripped global markets as investors realized the interconnectedness and fragility of the financial system. The fall of Lehman Brothers served as a stark reminder that even seemingly invincible institutions could succumb to the forces of a financial panic. Ferguson then examines the policy responses to the crisis, focusing on the unprecedented actions taken by the Federal Reserve under the leadership of Ben Bernanke. The sources detail the Fed's aggressive use of unconventional monetary policy tools, including quantitative easing, QE, and the provision of liquidity to struggling financial institutions. These actions, though controversial, were instrumental in preventing a deeper economic collapse. The chapter also analyzes the broader economic and political consequences of the crisis. The sources highlight the rise of economic nationalism, populism, and anti-globalization sentiment in the aftermath of the crisis. Ferguson argues that the crisis exposed the vulnerabilities of the China-RICA relationship, the symbiotic economic partnership between China and the United States. As the U.S. economy faltered, China's export-driven growth model came under pressure, leading to tensions and calls for a rebalancing of the global economic order. The sources suggest that the 2008 financial crisis was a product of multiple factors, including excessive leverage and risk-taking in the financial system. The sources point to the proliferation of complex financial instruments, such as mortgage-backed securities, that were poorly understood and highly leveraged. This created a fragile system that was vulnerable to a loss of confidence. Lax regulation and oversight. The sources argue that inadequate financial regulation allowed excessive risk-taking to flourish. The repeal of Glass-Steagall, a key piece of New Deal legislation that separated commercial and investment banking, is cited as a contributing factor. Global imbalances. The sources highlight the role of global imbalances, particularly the large U.S. current account deficit and the corresponding surplus in China, in creating the conditions for the crisis. Ferguson concludes by arguing that the slight depression offers valuable lessons for the future of finance. He emphasizes the need for greater financial regulation. The sources argue for more robust regulation to prevent excessive risk-taking and leverage in the financial system. This includes stricter capital requirements for banks and closer scrutiny of complex financial instruments. A rebalancing of the global economy. The sources suggest that a more sustainable global economic order requires a reduction in global imbalances. This could involve policies to encourage domestic consumption in China and greater savings in the United States. A deeper understanding of financial history. The sources emphasize the importance of learning from past financial crises to prevent future ones. Ferguson argues that a historical perspective can help policymakers and investors avoid repeating the mistakes of the past. Key lessons from the slight depression. The enduring importance of central banking. The sources demonstrate the critical role of central banks in managing financial crises. The Federal Reserve's actions, while imperfect, prevented a much worse outcome. The fragility of complex financial systems. The crisis highlighted the interconnectedness and vulnerability of the modern financial system. Seemingly isolated problems can quickly spread and create systemic risk. The need for regulatory reform. The sources argue that the crisis exposed the inadequacy of existing financial regulations. More robust regulation is needed to prevent excessive risk-taking and protect the stability of the financial system. The interconnectedness of the global economy. The crisis demonstrated the deep economic linkages between countries. Imbalances in one part of the world can have significant consequences for the rest. By analyzing the slight depression in historical context, the Ascent of Money provides valuable insights into the dynamics of financial crises and the challenges of managing a complex and ever-evolving financial system. The sources encourage us to learn from the mistakes of the past and to embrace a more cautious and historically informed approach to navigating the financial landscape. 12. From Sovereign Currencies to Cryptos, A Financial Evolution. The chapter From Euro to Ethereum in the Ascent of Money examines the evolution of money from the euro, a supranational currency, to cryptocurrencies like Ethereum, a decentralized digital asset. The sources showcase the dynamism of financial innovation, drawing parallels between historical precedents of financial evolution and the emergence of cryptocurrencies, while also acknowledging the enduring role of nation-states in shaping monetary systems. The narrative starts by revisiting the European debt crisis, a consequence of the 2008 financial crisis. The sources describe how the euro, initially conceived as a symbol of European unity and economic strength, became a source of vulnerability for weaker economies like Greece, Spain, and Portugal. These countries, locked into a single currency, lacked the ability to devalue their currencies or pursue independent monetary policies to address their specific economic challenges. The sources note that Germany, with its strong economy and aversion to inflation, resisted calls for a more centralized fiscal response to the crisis, exacerbating tensions within the Eurozone. This section highlights a key theme from earlier chapters in The Ascent of Money, the complex relationship between money and state power. While the creation of the euro was intended to foster economic integration and stability, it also exposed the inherent limitations of a monetary union without a corresponding fiscal union. The chapter then shifts focus to the rise of cryptocurrencies, a phenomenon that has gained significant traction in the decade since the 2008 financial crisis. The sources introduce Bitcoin, the first and most well-known cryptocurrency, as a potential disruptor to the traditional financial system. Bitcoin's decentralized nature, operating on a blockchain technology that bypasses central banks and governments, is presented as a radical departure from the fiat currencies that dominate the global monetary system. The sources draw a parallel between the rise of Bitcoin and previous episodes of financial innovation. They note the skepticism and dismissal from established financial institutions, reminiscent of the resistance faced by early pioneers of banking and stock markets. The sources also acknowledge the speculative frenzy surrounding Bitcoin, comparing it to historical bubbles like the Dutch tulip mania. However, the sources also suggest that cryptocurrencies represent a genuine innovation with the potential to reshape the financial landscape. The chapter explores the potential benefits of cryptocurrencies, such as decentralization. Cryptocurrencies operate on a distributed ledger system, removing the need for a central authority like a central bank. This could potentially reduce costs, increase transparency, and enhance financial inclusion for those lacking access to traditional banking services. Security and immutability. Blockchain technology, the foundation of most cryptocurrencies, provides a high level of security and tamper-proof record-keeping. Transactions recorded on the blockchain are virtually impossible to alter or erase. Scarcity. The supply of Bitcoin and many other cryptocurrencies is limited by design, potentially offering a hedge against inflation and a store of value akin to digital gold. The chapter also examines the challenges facing cryptocurrencies. Volatility. The prices of cryptocurrencies have been highly volatile, making them risky investments. Scalability. The current infrastructure for cryptocurrencies, particularly Bitcoin, struggles to handle a large volume of transactions. This limits their adoption for everyday payments and commercial use. Regulation. Governments and regulators are grappling with how to oversee cryptocurrencies, with concerns ranging from money laundering and illicit activities to consumer protection and financial stability. The sources conclude by suggesting that the future of cryptocurrencies remains uncertain. While Bitcoin and Ethereum have captured significant attention, the chapter acknowledges the possibility that other cryptocurrencies or even government-backed digital currencies could emerge as dominant players. Key lessons from Euro to Ethereum. The dynamism of financial innovation. The chapter showcases the constant evolution of finance, with new technologies and instruments challenging existing structures and paradigms. The emergence of cryptocurrencies is presented as the latest chapter in a long history of financial innovation. The enduring role of nation-states. Despite the decentralized nature of cryptocurrencies, the sources acknowledge that governments retain significant power in shaping monetary systems. The potential for government-backed digital currencies and regulation highlight the ongoing interplay between state power and financial innovation. Learning from history. The sources draw parallels between the current cryptocurrency boom and historical episodes of financial innovation, emphasizing the importance of learning from past successes and failures to navigate the complexities of a rapidly evolving financial landscape. The chapter From Euro to Ethereum in the Ascent of Money offers a thought-provoking exploration of the latest chapter in the evolution of money. It encourages readers to consider the potential of cryptocurrencies while remaining mindful of the challenges they face and the enduring influence of nation-states in shaping monetary systems. The sources invite us to embrace a historically informed perspective to better understand the ongoing interplay between innovation, regulation, and the future of money. 13. Conclusion. The book The Ascent of Money concludes by emphasizing the continuous upward trajectory of finance, despite occasional setbacks and contractions. The sources highlight that the financial system has reached unprecedented heights of complexity and sophistication since its humble beginnings in ancient Mesopotamia. Ferguson argues that the evolution of finance mirrors Darwinian principles of natural selection, with new financial instruments and institutions constantly emerging and competing for survival. While some innovations prove successful and endure, others fade away, leaving behind valuable lessons for future generations. The sources underscore the importance of studying financial history to gain insights into the dynamics of financial markets and the challenges of managing a complex and ever-evolving system. By understanding the patterns of the past, investors and policymakers can better anticipate and navigate the financial landscape of the future. The book concludes on a cautiously optimistic note, recognizing the inherent dynamism and resilience of financial systems. While acknowledging the possibility of future crises, Ferguson suggests that the financial system's capacity for adaptation and innovation will ultimately propel its continued ascent. Thank you for listening. I hope this content is useful to you. If you like this kind of content, please like, share, and subscribe to our channel to support our team.